estate in 2013 actually was a fantastic, yeah, it really was, right?
Blessing in disguise.
Without question. And so, initially jumped in doing a lot of single family spec builds, fix and flip, new construction, single family types. So from like 2013 to really like 2020, but I'd say from 2013 to 2018 was really where I honed in on the building of single family homes. This was kind of like my first introduction into construction, where I really learned how to, develop a budget, understood the pricing of materials, which I didn't realize would have such an impact later on in developing multifamily. But, with that information and that knowledge allowed me to, really set myself apart from other developers because I was able to set my own budget versus having, a contractor set the budget on my behalf. So it really just gave me a leg up. Again, from 2013 to 2018, 2020-ish, did about...
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. I have a friend of mine here, Tom Clayton, who's a NFL player turned developer, real estate operator. How you doing today, Tom?
Man, I'm doing great, Captain Kidd. How are you, man?
Really good, really good. Always good to talk to you, as we both of us kind of geek out on the real estate stuff. We go deep into a lot of different things. But for people that don't know you or haven't met you before, tell us a little bit about yourself.
Yeah, absolutely. So played in the NFL from 2007 to 2013. Played with a number of teams. Started with the 49ers, ended with the Arizona Cardinals. And within that time, I did get introduced to real estate. And towards the latter parts of my NFL career, I was really starting to, put a lot of attention into real estate. And it just so happened to come at a perfect time because, going into my seventh season, I had gotten hurt, right? I was projected to play for 10 years. It got cut short to 7. And this was in 2013. So I was really thrusted into the real estate market a whole lot sooner than I anticipated. But in hindsight, getting into real estate in 2013 actually was a fantastic, yeah, it really was, right?
Blessing in disguise.
Without question. And initially jumped in doing a lot of single family spec builds, fix and flip, new construction, single family types. So from like 2013 to really like 2020, but I'd say from 2013 to 2018 was really where I honed in on the building of single family homes. This was kind of like my first introduction into construction, where I really learned how to, develop a budget, understood the pricing of materials, which I didn't realize would have such an impact later on in developing multifamily. But, with that information and that knowledge allowed me to, really set myself apart from other developers because I was able to set my own budget versus having, a contractor set the budget on my behalf. So it really just gave me a leg up. Again, from 2013 to 2018, 2020-ish, did about 100 single family homes. So did really well with that. Cash was really good. But, in the capital gain, with the capital gain strategy, in most cases, you spend that money just as quickly as you get it. So, had the revelation at that point, kind of around like that 2018, 19-ish, to make a pivot, into multifamily, which was to then develop and hold. I had already figured out my model that I would purchase and construct within 70 to 75% of that end value. So I already had the strategy built in from when I was a flipper, developer of single family. I just segued that same model into multifamily. And in doing so, I've been able to create a, fairly substantial real estate portfolio that I've developed, owned, and managed, which sits today, in terms of my total volume, I'm about 120 million in total volume that I've developed. And then that of which I hold is more than 50% of that I hold in hard assets. So around like 60 to 65 million that I hold that today cash flows, it's a 7-figure cash flow portfolio that, it's just my wife and myself. Our structure is, our build out is she and I as decision makers, and we have a really, really large construction team underneath us of roughly about 100 guys 3 construction managers in all phases of construction, MEP trades to carpenters to you name it. We have them in house, and we segue that over into operations as well for our multifamily portfolio. So that's all me in a nutshell. And then we can obviously dissect all of what I did there. Yeah.
So you're basically vertically integrated with everything. That's great, because then you can control the product that goes in and out. You get to choose. And what would you say nowadays is one of your biggest struggles when it comes to construction and doing some value add work?
Sure. And I've done both phases where I do adaptive reuse conversions, which would be considered value add, if you will, and then also do tons of new construction, a lot of townhouse development, new construction apartments. But I'd say the biggest hurdle, if you will, is really just the time it takes for projects to get approved, right? We always make the joke that you could have 2 babies, right? You can have 2 babies before you get a project approved, which on the back end of it creates more households that need housing before there's a house to actually put them in, right? Yeah. So the whole the way that this thing is structured just is very imbalanced. Now, I live in the Northeast, right? I'm in Rhode Island, southern Rhode Island, right on the coast, gorgeous section of the map. But I live in the state that is the second most populated per square mile in the entire country, right? So it is massively populated here, and the demand outstrips the supply by a very long shot. And then again, if I go back to how much red tape, you have to cut through to get something approved, there's no way that we'll ever catch up to the demand. You've got people who, Rhode Island in particular has been rated top 10 in inbound migration since COVID. It already had a robust population prior to that. Because in comparison to the 2 markets that it's sandwiched between, which is Boston to the north, New York to the south, even though we are a top 10 in expense across the country, it's quite expensive here relative to the other 2 markets. We are a fairly amount of a discount. Right. Mm-hmm. Just to give you an idea, my average rent in my portfolio is about $3,000 for the type of product that I bring to the market. If I were in Boston, it'd be $5,000. Mm-hmm. In New York, relatively in that same. Yeah. Right. So being able to have, a luxury product, on the coast that still has great access to both of those markets really makes Rhode Island the sweet spot. Now it's starting to become an area that people are starting to learn more about, or I should say, who have learned more about it, and they're starting to come here a lot more frequently. And the more you experience it, you're more like, hey, I need a part of this state, one way or another, whether that's the purchase or rent. And that's really how the numbers continue to increase because more people are coming. And then again, like I mentioned, it's difficult to get projects approved. I don't know if it's because it's one of the 13 colonies and there's just, strict rules around, how they like development, in this northeastern part of the country. But that is the barrier of entry is what makes the project so much more valuable here. And I'm grateful to have discovered this market. It was kind of indirect. I played with the Patriots and I had a home here. And so when I started real estate, hey, I started in New England. It just so happened. You market. Yeah.
Funny how that works out that you start where you are first. And, I know Rhode Island in general has always been kind of that playground place in between Boston and New York. And it's always been expensive, but relatively inexpensive compared to New York and Boston. And I've known other people tell me the same thing, that the barriers to entry are what makes the niche so good if you know how to get through all those nuances of all the different, all the different regulations and stuff. Because I know, every place has its regulation nightmares upsides and downsides. Because I know that, people always talk about New York and Boston are very slow, but I would imagine, how it would compare to those 2 markets right near there. Would it be quicker to execution?
Well, I'd say that there's been more incentives maybe placed here than other places just by way of the size, because it is such, hey, it's the smallest state. And when you have such an overpopulation, there needs to be new laws introduced. So most recently in 2024, new laws were passed in the state that allow for adaptive reuse projects to be now by right. To give you an example of the significance of that, I just recently completed a church conversion project. Okay. And, in order to get that project, it took me 3 years in total from, concept to completion. Now, majority of that, I'd say 18 months plus, was getting the approvals. It only took me about a year and change to do the project. And it was an extreme project, but I've got the manpower to take on projects like that, which I did that one amongst 6 other projects. But it was a 15-unit conversion of about a 20,000 square foot building in total. Okay. Now, fast forward to this year. Okay, I did that one. Let me see. I purchased that one in 2022 and finished it in 25. Okay. Now I made another purchase in 2024 of a nursing home, relative in size, about 20,000 square feet. I'll convert that to 26 units. I'm actively converting that to 26 units now. That one was already by right. So I didn't have any red tape to cut through. So it was just a matter of creating the plans, showing the city the plans. Okay. And then from there, getting the permits to begin the project. So that cut through a year and a half, probably saved me 150, maybe 200,000 of what it would have cost me, in fees to get a project approved. So it saved me time, it saved me money. And now I'm able to put units into the market that didn't exist before. Okay, in a section of town that is in dire need of new housing. Right. All because of this new law that allows me to, essentially jump in front of the line and get those things constructed. So I'm grateful for, new laws such as that. Not familiar with anything that they're doing in Boston outside of them giving like density bonuses.
Yes.
And as far as New York, I think there's some sort of like tax abatements that you can get. So, there's incentives in various ways, but I think the one that's most meaningful here in Rhode Island is adaptive reuse projects being by right.
Well, so let's take a little more deep dive into this assisted living. So basically, that one you were able to move ahead because they let you fast track a lot of the permitting and everything. Whereas with the church reuse project, you had to go start to finish. Was that 3 years to lease up and being fully occupied?
Yeah, so that 3 years took me all of going through the variance process, all of the pre-construction process, the actual construction process, and then the lease up. So what we'll do for lease up anyhow is we'll actually piggyback that during the construction phase. So we're about like 80% complete. We'll already have a spec unit that's well in advance of the other ones, so that way we can start showing prospective tenants, what they could expect, give them price ranges, and then at least have them walk through and get a feel for what's there. We'll typically get 25 to 33% of our leases from that point. But we really don't go gangbuster until it's complete. Then once it's done, we'll lease it up seemingly in an instant. But we still like to get that early foot traffic just so we can get a buzz going. There's no better marketing than to actually have people walk through.
I would think so. And then you get the word of mouth and you get, people start talking about the product that you have going out. That's definitely, if you can pre-lease soon, that's to your advantage, because once people can actually see the units, granted, a lot of times the timelines may or may not work out, because if you pre-lease too soon, these people are probably need a place, within 6 weeks or a month, so you're like, if you go too soon, then they, you have to put them on the list with everybody else and they probably go away. But the assisted living, how are you able to jump ahead on that one?
Yeah. So what made that great, right, is we didn't have a variance to go through. We didn't have any NIMBYs to cut through. Now, what we did do, just out of courtesy for the neighborhood, we did host a meeting, right, to allow everyone in the town or the surrounding neighborhood to know what we were bringing. But they didn't have the ability, because of this new law, they didn't have any ability to reject it or say or rise up against it. So that was just phenomenal, right? And then this law it's been so impactful that, a good part of my business is I actually search for buildings that can be converted to multifamily that are currently, because the way the law is written is any commercial building, any industrial building, anything that is not necessarily zoned residential today, if it has the size to be converted into multifamily, it can be by right. It's just an extraordinary new law. And I think it will, have a difference, will make a difference. In fact, I've got another nursing home that I've got in my pipeline. That's about like 35,000 square feet, and we'll convert that to 58 units. It's right out of the airport in Warwick. It's a nice little, cute little village called Patuxent Village, little coastal town. You can look it up. But that's another opportunity. So we've designated, or we've set aside a portion of our search to find commercial buildings that are either obsolete, can be converted, or there's something about them that makes sense to take a look at to convert to multifamily.
I would think you probably look for things that are of similar, because office buildings are kind of tough to do a conversion because they don't necessarily have all the plumbing and the electrical and stuff like that. Whereas assisted living, they already have all the runs and the electrical plumbing, stuff like that. That's kind of already there, so you can kind of reuse, maybe not necessarily reuse what's there, but you can at least get it permitted in pretty quick because it's replacing existing and stuff like that. And a church probably had a lot of different rooms and meeting areas and stuff like that, and bathrooms and stuff. That must have been I remember you sending me the pictures of it. That was pretty interesting. Pretty interesting project, and I really did. I'll mention this before that I liked how you kept the stained glass, the original stained glass, and you said that it was a requirement to keep it, but I think it just kind of kept the character on the outside of the place. So I imagine there's a lot of big nuances that you have to do to play nice with the city or the town or the county, because they're probably going to have a different vision than you are. Are you seeing much pushback in that regard, or is it just kind of, because I know we're at a shortfall of units, especially in Rhode Island, where you don't can't necessarily build new so easily or so quickly. Are you seeing any competition from any new construction?
Well, that's a great question. Well, I say for us in particular, we serve like the middle market. So that's like projects from between 20 and say 100 units. And we're really hyper focused on projects in that 20 to 60, 80 unit size range. So in terms of competition, there aren't very many that fit into that box. So fortunately, when a deal comes up, a conversion project or new construction that's in that realm of, 50 some odd units or so, we're the first call, and I'm grateful to have worked to get into that position. But I'd say little competition in the middle market development space. I'd say the majority of the units that are being brought to market here in Rhode Island are downtown, and they are typically funded by Brown University, who is a major developer in downtown Providence. Other than that, you got a lot of merchant builders, single family types, whether they're, built, and primarily they build to sell. Like in terms of building to hold, I think I'm like one of the lone stars here, strategy. But that's more of a, I picked that up from, hey, I sold over 100 homes, and I realized that, granted the capital gain was wonderful at the time, but I didn't have anything to show for it, a year or two after, other than, beautiful portfolio pictures. Whereas the homeowners that, made those investments have resold in years past, a year or two after, and they've made 100, 200 grand off of the same work that we were able to produce. So not that, we shouldn't have sold those homes. It just makes more sense for us now to go ahead and hold them, because we see that the value is over time. The value, to sell today is just a snapshot of what the market can produce. Whereas if I hold it, then I can ride the wave of all the, progress that one particular asset can make.
Yeah, and it just makes sense. It worked well for you at the time because you had that learning curve. That was kind of your university education in real estate, and you realized that the long game and the long haul is where the long generation wealth is. But we all, I myself did the same thing. We sold some properties that had I kept them, it would have been a different story now. But it did get us both into the next level of what we should be doing. And, you can always do both at the same time. You're going to have to sell at a certain point. Every area is going to cap out. So you need to readjust the portfolio and stuff and move things around.
Hey, Scott, but I'll tell you this though, right? The way that we work our numbers and we work our finance, we're able to do an infinite return. And I'll break down what an infinite return is.
Okay, great.
With this infinite return, we're not technically, we don't ever have any motivation to sell. And I'll tell you why. So when I say infinite return, what that means is all of the initial equity that I put into the deal, because we do develop and then we hold. So when we purchase a development project, there's a bit of equity that'll have to go into it. Now, post-construction, we'll do a cash out refinance. Now, because so much value is created through that construction, okay, we're able to then get a much larger value at the end, which the bank will give us, say, 75% of that value. That 75% that the bank gives us pays back the construction debt in full, pays our equity back in full, and in most cases also gives us extra cash to take off the table, meaning we don't have any money in the deal, meaning all that cash flow that comes in or all that income from the building takes care of all the expenses as well as pays us cash flow with none of our money in the deal. Every single deal that I hold, that whole $100 million that I explained to you has been created through that strategy that I just shared. We don't have any capital in the deal post-construction. So we technically don't ever have to sell because we're not looking to recoup any money. There's no IRR that we're in search of. Yeah. We're not looking for anything other than to operate this thing to perfection, to optimize, that asset and to make sure it's kicking out as much cash flow as possible. But outside of, that level of operation, we're not seeking to gain capital back at any point past that initial cash out refinance.
Well, that's definitely one of the best strategies because also when you're doing the cash out refi, it's not profit, it's actually debt, so there's not really any taxes on it. And then also you're not beholden to any of your investors because it's just yourself and your wife, so you don't necessarily have to sell at any time. There's no business plan that is that. So it's a great strategy. People always brag about how many doors and all this and that, and everything like that. It's more of an ego thing, but everyone has to do what strategy works for them. And what you have is, it's all self-contained and vertically integrated, so that when you cash out, that's not a taxable event. There's no capital gains. And then also, you're not beholden to anybody else. Like if the property or something, the area starts to not be so good, you can sell it if you want, or you can, turn it over or do whatever you like with it. You're not beholden to anybody else. So it's a great strategy for infinite returns and a great tax strategy also. But
100%. And then also too, the type of financing that you couple it with, you couple it with, high leverage debt out the gate, because again, it's construction. So most construction will go, depending on what type of lender you use, but in base case, you can get 85% loan to cost.
Loan to cost, yeah.
Meaning 15% is the amount of equity that we'll bring in. But now we've got such relationships with our lenders where it's 95% LTC. So it's a lesser of a nut just because of our track record. They know that we'll deliver and they get a better interest return the more capital that they put out, right? So if they trust that operator, as in Touchdown Realty Group, then they're more confident in, kicking out, say, 8 figures in debt for the project because they're confident that we'll deliver. So that comes with, a great track record and obviously great performance over time. But that's allowed us to put smaller and smaller amounts into these larger and larger deals. And then obviously with the large team, we're able to execute, and it's really put us in position, to be able to have generational wealth, which is, what we've secured at this point.
Well, and it also is a testament to, that, over time, you've built a great team. And you also have these great relationships with your lending partners, whether it be a community bank or your other private lenders. It just shows that it's 100% a relationship game. All your success is built on all the relationships that you made, and you just keep expanding on that. And then you get instead of 85% loan to cost, you maybe get 90 or 95. So you only put in. So if you think about that in a $20 million deal, you're really only putting in $1 million, and then your returns get higher and higher at that point. And then when you do the construction takeout, you're at 75 loan to value, which that's probably over the original loan to cost. So where the math becomes that infinite return, like you're saying, where it just goes exponential at that point, because the longer you keep it, the longer value it is. And then when you go to refinance again, probably 5, 7, 10 years, or what kind of debt products are you usually with a construction takeout? Are you seeing like 7, 10 year
10 year,
loans?
10 year AM at 30 year, which is,
And
which
30
is
year M.
30 year AM, which is, I mean, that's pretty standard. We have a lender, okay, DSCR lender, that'll do a 30-year fixed on a 5+, which is, that's
Really?
unheard. Oh yeah, but we have that on. We did this one really cool project. It was a small new construction, but the numbers they kick ass. So I bought the dirt. It was for 16-unit new construction. I bought the dirt for $500,000. This is in 2022. Okay. The construction to build those 16 units was $3 million.
Okay.
And at the time, I bought it in 2022, so I'm looking back at rents in 2021. I'm figuring, okay, this will probably be, $2,000 at 2,100 per door. They were all 2-bed, 1.5 bath, being kind of conservative. Fast forward 18 months from the time I purchased it. So in 2024, those rents are at 27, 2,800, right? Project still only cost $3 million to do. None of that changed. And it ended up appraising for like 7.2 million. So I'm like 50% loan to value on that. So not only were we able to return on construction debt on that refinance, we were actually able to take out, several $100,000 in cash as well. And then that project in particular has a 30-year fixed DSCR loan that's fixed for 30 years. Now the rate isn't great. The rate is like 7. Okay. Which is kind of catching up. It's like, it's not that bad.
Yeah, but it still works though.
Oh, it works. Oh, it absolutely works. And it works because the cash flow is so strong. And that's, market forces, I underwrote it from yesterday's numbers. By the time I brought it to the market, we're in tomorrow's numbers. So, and then that project in particular is in a place called Bristol, Rhode Island, which is surrounded by water. It's very close to Newport and get back to Providence. So it's an ideal location. There's very little development there. We obviously brought the newest, brightest thing that city's seen, so it's in high demand. I think we've got rents at 32.5 now.
Yeah,
so they keep continuously go up.
Well, Bristol is always a nice little town, and that there's a thing in the yachting world they used to call it when you have something dialed in right, they call it in Bristol fashion. So.
Hey.
So
that's right.
and I believe they used to build some really nice yachts and stuff there. I can't remember, but no. But that just another great point is that the rate's the rate. Even if it's people say they're really high now, but they're really not. They're actually in kind of historical averages. But it's just the prices have not equalized with that yet. So, and then there's always, buyer and seller dispute as to what things are worth. But now the sellers are going to, in multifamily especially, has been coming down. But if it's, I heard somebody say, look, I will borrow $1 billion at 7% all day, every day, because I know I can, if I can make 8 or 9, it doesn't matter.
Doesn't matter.
Or 10, or whatever, it doesn't matter.
Exactly.
So that's just a hint, for everyone. Just kind of don't get too caught up in the rates. Just make sure the math works, and make sure that you're dead on your due diligence and your cost projections, because like Tom was just saying, is that the market was completely different by the time he went to market, and it was actually hugely in his favor. So, I mean, we had that happen as well,
That's Rhode Island, though. That's Rhode Island because, again, as I mentioned earlier, there just isn't enough housing, right? So when something does come to market, which, obviously there's, a number of projects that, units that are brought annually, they're always going to be that much more valuable because it isn't anything new to pick from. So this is just one of those sweet spot markets where, development, I'm just super bullish on development here. And I have been since 2013. You're right. Yeah. There hasn't been anything to take me off of that. And in the future, thinking of, what the market holds and what the trajectory shows, it looks like it'll be a bull run for quite some time.
Yeah, especially because as we were discussing before, we're heavily into development as well, and we're very bullish on all of it. just because in some of these growth areas and stuff, there's just not enough to go around. And sure, the rates are the rate, but if the numbers are working now, when things kind of because you're seeing, like in multifamily, a little bit of a softening in some areas, and there's a bit of overproduction in some areas, but we're seeing a lot of that level out because a lot of developers went pencil down, whereas some guys continued. But I think the guys that continue are going to fill that gap, and the gap's only widening because of this pause.
Sure.
And
Yeah, you nailed it. You nailed it.
we're going to be a shortfall for quite some time. And also the prices in the residential real estate have not really come down enough because they're at a shortage also.
Right.
So you're going to see, I'm seeing like a rise of a lot of these build to rent type projects that are I guess they call it like a tweener project, where they're people want to get out of maybe an apartment space and get into a home, but they can't quite afford the home, so they rent a townhome where they can have the dogs and they can have those things. And then also I'm seeing with the baby boomers retiring, they want a low maintenance lifestyle, so they want to, hey, I still want to kind of have the house, but I don't want to have all the maintenance. I don't want to have to cut the grass. I don't want to have to do all the cleaning and do any of this stuff. I did that for 20, 30 years.
100%.
I don't want to do that anymore. So we'll just pay the rent and make the call when there's issues. And if it's a brand new product, chances are for 5, 10 years, there's not going to be a whole lot that's going on with it.
And exactly. Yeah. So outside of adaptive reuse, the thing we do most is townhouse development. So we do a lot of BTR. I'd say we've done, I'm working on my third townhouse community right now. Very well located, amenity rich. It's right off of I-95. You can get to nightlife, entertainment, get to the international airport, top rated international airport, by the way, within 5-10 minutes. TF Green here in Rhode Island.
Oh yeah, very nice.
Rated top in the country. So this locale where I'm building this BTR is just very well located. Now, obviously, going into the project, we have the ability to, price it as if we're going to sell it. These units, they're roughly about 2,000 square feet in total. 2-car garage attached, 3-bed, 2.5 bath. Which in the open market, if I were to sell these, which obviously I underwrote them for sell and rent, if I were to sell them, they would go for roughly about 700,000. 650, 700,000. So you times that by 20, so 20 units. That's a $14 million asset. If I choose to rent them, they would go for somewhere in the order of about $4,000 a door. Maybe it's 4250, something like that. So it will more than carry the weight of that mortgage in the event we do decide to hold. But I do like the townhouse developments because, again, they are individual units that could be sold by themselves. Mm-hmm. They could be sold in a tranche because there's 5 4-unit buildings, so I could sell them as separate 4 units. Sell them individually. I could sell it as a plot. Or I could hold it, right? So the amount of exit strategies that BTR deliver, like townhouse developments deliver, is unmatched. And so we make sure that we do our really good share of those alongside of our apartment developments and conversions as well.
Yeah, I see. As we were discussing before, like with our stuff in Dallas, same kind of thing. You can build them in like 5 to 10 tranches, and then sell them off. As you're building and you get close, you start selling them, and then, if the market's not quite right for selling them, then you just start renting them. And then you have that gives you that buffer. And then what's good about it, like you said, is each one of these is an individual plot. So, that's, again, another hint that you can do in development is give yourself a lot more exit strategies and stuff like that. That's, with our Dallas project, we have 3, each one of them has 3 parcels. So they're separated so that you can do multiple different things. One's like a flex space, one's built to sell townhomes, the other one's multifamily. So you can do them all at the same time, and then start doing it to where, you can start leasing up or selling after 6 to 9 months, so that velocity of capital is fast. Exactly like what you're doing. Like if you're, hey, I'm taking on this bigger project over here. All right, let's start selling these, and then move it into the other thing. So you have options to where you're more in control of the product.
100%. And, not to mention, right, as you well, just kind of to piggyback off what you mentioned before, a lot of people are, the American dream isn't so much to own a home anymore. American dream is to have flexibility. The American dream is to be able to have an amenities package where you're not paying for insurance, you're not paying tax, you're not paying for maintenance. You just show up, you enjoy your lifestyle, take trips as please, and that's the new American dream. So, the ownership is being shifted over to professional owners, to maintain and take on, whatever comes their way, which, and if I were to switch shoes, hey, I'd probably be a renter as well if I didn't have kids. I wasn't do this for professional shit.
It's true. You raise a good point because it's kind of more of a turnkey lifestyle. You buy, like you rent an Airbnb or you do a midterm rental for a month or two, and then you just turn keys, you show up, you get the keys, you don't deal with anything else. And there's something to be said about that because I did when we sold our last home, we moved into a high-rise apartment. It was something that was very nice about just kind of parking the car right by the apartment. You can go downstairs, use the pool, use all the gym, use all the clubhouse, everything, and the grill, and you don't have to deal with any of it. There's no cleanup. There's no, granted, you have to be, you have to be considerate of everyone else. But
they do it.
Yeah, but they do the deep clean. You do the, but then you got the full gym, the pool. Hot tub, steam room, all that stuff. And I've had other friends that are real estate investors, and they have young kids, and they're like, "Well, let's live in a high rise for a little while," and they have enough cash flow to pay for it. And they're like, "Look, I don't have to deal with any of it. I park my car, and it's covered parking." And everything else. I got a nice amenity space. I got, nice big clubhouse. I have my family over. We can all go down there and sit and hang out there. There is something to be said about that. And I think that turnkey lifestyle or that amenities is something to be said about that, because especially the younger generation don't necessarily want to commit to a 30-year mortgage, even though in the U.S., none of us ever usually commit to the 30 years.
But it's an opportunity, right? No other country on the planet has a 30-year fixed. Okay, nowhere. But it's an opportunity. Obviously, the American population is a bit spoiled. I think we can both agree on that. So it's a lot of times, it's hard for them to see how much value is actually being presented to them. But I think overall, with how society has become today, very microwave society. I want it right now. That doesn't equal home ownership. When you're owning something that is for the long term, you're willing to take the bumps and the bruises that come along with home ownership. You may have just a random, fix that you have to adhere to, or just some random thing you have to come up. But when you're leasing, that's not your responsibility.
No, it's not.
Right. So people are really starting to gain the understanding of what it means to be a renter and the power in renting and what that does to your flexibility.
Yeah, and also, in some areas, it may not make sense for you to buy something there, especially in some of the higher, the more
areas,
the luxury areas, it might be much cheaper to rent and buying a place, even if you've paid the mortgage for 10 years, would you have been better off, renting for 10 years? It just depends on what you're doing with that capital and stuff like that, and I would say, a lot of times here in the States, a lot of people overlook a lot of the things that don't exist in other countries, like a 30-year mortgage, like you're mentioning, that doesn't exist anywhere else. And when people come here and they see that, they usually, the first thing they do is buy a home because it was not even possible in their home country at all.
No, agreed. But also too, kind of where we're headed. We're already, midway through the 2020s. It just seems less and less likely that someone on the lower end or first time home buyer is actually going to buy a home. It seems more likely that they'll rent and then be happy renting. I think it's all psychological. Once you get past that point of, I'm going to be renting forever and this is a problem, but it's really not a problem because you got more investment vehicles than you've ever had in any point in time in America. right?
Yeah,
So you
that's
don't
for
need the
sure.
home as a means of your largest investment. That doesn't have to be the case. You can
No,
invest it across a number of opportunities now that
yeah.
weren't present before.
Yeah, and there's that's just like you're saying, that's just another good hint is that there are so many investment vehicles. You know, we're both real estate guys and stuff like that, but it's not necessarily for everyone, but they should be a part of your portfolio somewhere because it is a very stable asset and there's a lot of things that you can and you do have access to. I mean, think about in the 70s and 80s, you couldn't go and just buy a stock on your phone. You know,
Right?
you couldn't buy a business on your phone.
Or crypto.
You know, and now you can buy biz or whatever. I was a friend of mine told me he was bidding on a couple businesses on his phone. I said, really? He said, and he said, yeah, I do it. That's what I do. And I said, okay, well, it's just your comfort zone, your level of risk. You know, and some people think, when I say development, I'm sure you get the same thing. People go, oh, that's risky. And I'm like, well, depends. It's calculated risk. Like our development team, our development partner, they've been doing it for 35 plus years. So to them, what they consider conservative is might be really risky to somebody else.
Agreed.
And
Agreed.
some people think real estate in general, is risky. I like flipping homes and stuff. When you tell me you flipped 100 homes, like me, that sounds like, wow, that sounds pretty risky just because I've never really done it. I've always held it for a little bit, but some people are buying and flipping land and doing that, locking up 20, 30 pieces of land. Right now, I know a guy that's doing that and he flips them all to developers and he's got money all over town that he's locked into all these pieces of land. And I said, well, what if the land doesn't sell? And he goes, no, it'll sell. I was like, okay, well, good for you. It's like,
Land
I don't
banking.
have the mindset, I'm not tuned into that. So
Yeah.
it works for him.
Yeah.
It
I'm
works
more of
for
a
him.
creative type. Like I need to create something with whatever I'm purchasing. So I like to buy it distressed or buy it make it raw, and then I create something on it. There's others that have no creative bug whatsoever, and they can land bank, sit on it, they sit on a distressed asset and just sit.
Yeah.
Because time will. I mean, and I've purchased things from people that haven't done anything to them, but the value of that thing has just increased over time. So nonetheless, they've got market forces in favor. So.
Yeah. It just shows there's just so many different ways to do it with real estate and buying assets in general. When you have assets, you have options. When you have options, you have freedom.
Well said.
And it's just such that's why I love it so much, is I'm hearing so much about different things. And, I always learn from everybody I talk to because, there's so many different ways to do it. And what works for me may not work for you, but it could work for a bunch of us. You know what I mean? Like there's a lot of team projects and stuff like that. That's what I like about the commercial real estate in general. So what is next for Tom Clayton?
Yeah. So, right now, my target really is $250 million. That's my target right now. And we got a great path to get there. My focus really is obviously I'm under construction on several projects currently. So I'm really looking to just get ahead of those, get those on a fast track. And then going into 2026, I've got about 150 units that I plan to acquire, or I should say 150 units that I plan to develop. Okay. But those are my acquisitions, development projects. Okay. So I plan on doing that and then just continue to keep the cadence, right? My target is $250 million by 2030. We are on a good trajectory to get there. And, that's what I'm working towards. And, and obviously, being of value to those around me and things of that nature.
Well, I think you'll probably get to that $250 million a lot quicker than you think.
I hope so.
No, you will. I know how you are. You're going to keep going till you get it. And it's, when we set goals like that, we always, when we keep going at it, we always surprise ourselves at how far we can actually go in a shorter time than we actually thought when we just double down and keep doing it. Well, this has been really good. And as always, I love talking to you. And we always have great conversations. If people want to find out more about you or just get into contact with you, how do they find you?
Sure. So we've got a website, pretty easy to find. It's Live, Live, Lux, Luxe, lease, lease.com, liveluxlease.com. I believe we have an Instagram as well, at live.lux.lease. And yeah, I mean, I'm pretty easy to find, and we're fairly active on the Instagram platform there with photos of current projects and things of that nature. So, if anyone hears this and just wants to send a line, hey, we're always open to respond to. So,
well, that's really great. I really appreciate you coming on and talking with us, and we'll definitely be following up in a little bit when you get because I know you'll probably be closer to that $250 million a lot sooner than you think.
I'm ready to rock, man. But yeah, Scott, I enjoyed this thoroughly and look forward to the next one.
All right. Well, thanks again. And this is the Scott Kidd, the Yacht Captain Investor Podcast. Always as a reminder that you are the best investment that you will ever make. Thanks, guys.